Welcome, ladies and gentlemen, to the inaugural Contango Global Growth Investor Conference Call. This is our inaugural investor call, and we're very excited to be here. I'm Marty Switzer, the CEO of Contango Asset Management, and with me today, live from Laguna Beach, California, is Portfolio Manager Jon Tringale. Hey, Jon, how are you?
I'm doing well. How is everyone today?
Very, very well indeed, mate. It's great to have you here, and we look forward to doing this on a regular basis. Ladies and gentlemen, just a bit of housekeeping with regards to how this session will work. We've got about 45 minutes allocated. In terms of the process, I'm going to spend the first part of the morning asking Jon some questions about how they're investing at the moment and the strategy that WCM is running. But then after that, we're going to go to the floor, and this whole session is about giving you access to the WCM team so you can understand how they're investing your money. It's the opportunity for you to ask me any questions that you would like. Thank you very much for joining us today. We look forward to doing this on a regular basis. And I might kick the morning off now by speaking with Jon about the WCM investment strategy and the Contango Global Growth portfolio. So Jon, are you there, mate?
I'm still here.
Yeah, good to hear, mate. Glad that you haven't left. So look, first up, Jon, just keen to get a bit of a flavour for the audience about the global macro environment at the moment. And I know it's not a big part of how the WCM team looks. It's not a big thing that WCM considers when it comes to investing, but obviously a lot going on right now in the global macro landscape on the back of what's happening with the bond market. We've got trade wars, we've got issues with China. What's your view on the global economic landscape at the moment?
Yeah, it's an interesting question, and I think we're in a pretty unique period of time because it's really for the last year or so that we've really observed this idea of synchronized global growth around the world. And I'm talking in terms of both GDP growth, where Asia's been strong for a bit, but in the last year or so, you've seen Europe turn. So it's not growing gangbusters, but they're posting some steady and consistent growth, which is certainly healthy for the global economy. And then here in the Americas, we continue to chug along. And at the same time, you've had not only this global GDP growth, but we're seeing pretty consistent earnings growth around the globe. Certainly, it's company by company, but speaking in general terms, we've seen for the first time in many years most of the globe participating with earnings growth. So I think that's been a big factor in some of the positive move we've seen in the equity markets. So that part's positive, but there are certainly plenty of landmines out there. You mentioned the trade war. That's something that we've been paying close attention to, and I think it's still too early to know obviously how things are going to shake out. I think given the interconnectivity of the U.S. economy, across really the whole world, I think a trade war would certainly be counterproductive and probably have some pretty meaningful political backlash here domestically. So it's tough to know with Trump how much is posturing and really how much he can even pass through legislation, because I know even his own party is trying to limit his authority on trade. So interesting things to watch. I also would comment that certainly some of the hard goods sectors are probably maybe a little bit more at risk relative to services and technology that's a little bit harder to tax across borders.
Excellent. And in terms of, I guess, there is exposure to China in our portfolio. Do things such as trade wars, or there was some issues last night with the Qualcomm deal not going through, one of the big American players in broad internet. Does that create issues for the sort of stocks that we have in the portfolio, or are these companies defensive because of the quality characteristics that they've been accepted or invested on?
Yeah, I would say the latter. So I think it's important for everyone to know that when we invest in emerging markets, I should back up and say that the bar for any business to get in this portfolio is extremely high, given that it's roughly 35 of our top ideas anywhere in the world. For an emerging market company, whether it be from China or Brazil or anywhere else in the world, that bar is even higher, both in terms of the balance sheet, and us looking for businesses that are, net cash on the balance sheet, so you eliminate that risk. But more importantly, the dominance of their business is even more pronounced. And we avoid emerging market businesses that are buoyed to or tied to their local economy, whether that be, metals or an underlying commodity or something that's really unpredictable. For all of our emerging market holdings, these tend to be extremely dominant businesses in what they do. So today, for example, our only exposure in China is a company, Tencent, that we've owned since 2012. And, that's a business we have a lot of confidence given, the penetration and momentum in WeChat, that can grow, even through a period of, if there were to be a hiccup economically in China. It's a business with enough tailwinds and enough momentum and enough a large enough addressable market they're going after to be able to really grow through even some dips in the economy. So, that's a little bit of insight into how we think about China. So, we're not going to be touching anything where the government has, perhaps that level of control that can be a little scary.
Yeah. And look, Jon, in terms of the performance of this strategy, it's been going for almost 10 years now, and the performance has been incredibly strong, and it's all based on the fact that WCM is very much investing for the long term. Can you just sort of touch on the historical track record that the manager has?
Yeah. So great question. We're going to hit 10-year track record at the end of this month, which is a fun milestone for all of us. If you look at our returns over time, we've averaged about 5.3, 5.4% greater than the benchmark per year. And of course, that's not 5% every year. It ebbs and flows a bit. But the one pattern you will find, and it's not an accident, is that we've tended to pick up a lot of our alpha in down markets. It's something that we manage to, both in terms of the stock selection side and also how we construct the portfolio, and some of the risk controls that are in place are all done first and foremost to make sure we can protect capital well in those tough markets. So if you look at our downside capture over the last 10 years, we've captured just about 69% of the downside. And each of the 3 calendar years where ACWI has had a negative return, which was 2008, 11, and 15. We picked up significant alpha in all of those years. So that's really our number one priority is protect capital, so we have more to compound when the market turns.
Yeah, okay. Thanks, Jon. So could you talk us through some of the recent additions to the portfolio and why they've been included?
Yeah, absolutely. So one we've just bought here this quarter is a company based here in the U.S. called West Pharmaceuticals. And I think it's an illustrative example because it shows how we like to play a lot of different businesses or ideas or themes we're seeing out there in kind of a consistent, less risky approach, if you will. So, one of the things we're observing around the world is there's certainly more pricing pressure and reimbursement risk for pharmaceutical products. There's a flood of generics and biosimilars coming to market as healthcare systems around the world are trying to reduce costs and improve efficiency. And so we're seeing pretty incredible growth in some of these complex biologics. So, as we think about how to profit from that, rather than trying to take a bet and buying a business hoping that they'll get the next drug approved and they'll come in and take a lot of market share, which has a lot of binary risk to it, we look for what we call are these picks and shovels plays if we can. And that's, of course, a reference to the gold rush out here in California in the mid-1800s, where, you had a lot of people came out west looking for gold. A few people struck it rich. Most people went broke. But if you were selling the pans and picks and shovels that the miners needed, you made a really nice, healthy income for a long period of time. So we like to look for businesses analogous to that. And so West Pharmaceuticals is a company that on the surface looks pretty boring. They're in the very mundane sounding business of pharmaceutical packaging. So think about the rubber stoppers that go in a syringe, or the test tubes that some of these biologics are stored in. It's a pretty boring sounding business, but it's one that West absolutely dominates. They've got more than 70% market share globally, and it's a very, very sticky business because there are really some huge competitive advantage that they benefit from. The most notable of which, the packaging for a lot of these pharmaceuticals is, for the Food and Drug Administration of the U.S. and for the approval process, the packaging is considered part of the drug. So when they're going through these testing, they need to be, then sold and used in the same exact equipment that they were tested in. And so, once the drugs get approved and they use West products, they're gonna use them, in perpetuity. And so, they make, just to bring the scale to light a little bit, they make over 40 billion parts a year. And again, kind of own this market where we have some pretty good structural growth from more biologics. And then the other exciting part about the West story to us is they're transitioning their product portfolio to more of these kind of high-end components, which is, some of this crystal zenith glass that doesn't shatter. And so you're looking at, some of these products going from, maybe 5, 6, 7, 8 cents to 75 cents. And when you think about, 75 cents for something that stores a drug with a dosage of, $1,000 or more, it's a no-brainer that you would stick with what you already have. And so as they move the product portfolio to more of these high-end products, they're going to get a really nice spike in margins and also returns on invested capital, which is really, the growth in returns on invested capital is really what we think is analogous to growing your moat and growing your competitive advantage, and is probably the most important metric in terms of stock appreciation over the long term. So we're really excited about how they're positioned to grow those ROICs.
Now, John, I'm going to ask you one more question before we go to the audience. And so before I do that, just to let the audience know, if you do want to ask a question, press star 1 and you'll go into the queue. And I'll ask John this question, and then we'll go and take our first audience question if there is a question ready to go. And Dre, our production manager, will take care of that. So John, you talked about West Pharmaceutical, I guess a play on the healthcare theme. A big focus for the WCM strategy is to focus on those stocks in the consumer technology and healthcare space. In terms of a consumer stock that's number 3 weighting in the portfolio at the moment, it's a brand that everyone knows well, is Visa. Can you talk us through why we're invested in that and what you like about the company?
Yeah, so Visa is a great business. It's really one of these network effect businesses where they've built up the interchanges and the networks to conduct payments around the globe, and so consumers go to where the payments are, and the merchants, of course, need to be able to accommodate the payment forms that consumers have. And so, we really think of it as being a toll booth on global spending. And the exciting part is that, while places like the U.S. have long ago adopted credit cards, and it's become a very large percent of retail spending, we're seeing other parts of the world just in the early innings of that, switching from cash to credit cards. And so you have some really strong secular growth from that phenomenon, and then you have just an extremely dominant market position and a lot of leverage in the business model where they don't need to invest very many incremental dollars, that they already have the infrastructure in place, and that those increasing transaction volumes are going to fall right to the bottom line. And so this is a business too that, some people talk about, what if inflation comes back? It's certainly a natural beneficiary of that.
Okay. Thanks, John. So look, we'll open the floor to questions now. Dre, do we have any questions from the audience?
Yes, we do have a question from Stephen Constrap. Go ahead, Stephen.
Hi, Stephen.
Good morning. Look, thank you very much for your presentation, and what you're doing is looking very exciting. Look, I'm a private investor and hence a worrywart. I look at things like we're putting money into Ferrari and things like that, which is terrific when things are going well. What I'd like you to just address for me, please, is we've had 10 years of growth. We're looking at maybe 3 interest increases for the Federal Reserve over the next 12 to 18 months. What should the punters be doing to sort of protect their investors. If you take the view, and I apologise if this is against your interest, but if you take the view that the America's maybe been a little bit high for a little bit too long, what should we be doing to sort of protect our international portfolios?
John,
in terms of shifting to different geographies or certain business models, or
yes, yeah, basically general advice. What are you doing, and what do you think the general punter should be doing?
Yeah, it's a great question, and we also run a non-U.S. portfolio, which here in the U.S. has gotten a lot of excitement and attention recently because I think it's a common concern among investors that the U.S. has had this coming up on year bull market, or I guess 9-year bull market at this point, where it hasn't necessarily been as straight of a lineup around the globe. So for us, the way we think about it is we're looking at it business by business. We're paying a lot more attention to where each company in the portfolio and each company that we evaluate is getting their revenues and their profits. There's a lot more economic sensitivity to where they're making their money than where they're based. So that's one thing. I think we're constantly doing an opportunity cost analysis of the portfolio, versus our global watch list, and making sure to the extent that certain names have had big runs and maybe are getting a little stretched on valuation, that we're paring those back. About half of our turnover in this portfolio is trimming from the winners and adding to names in the portfolio that have been out of favor. So for us anyway, that's something that we're constantly in tune with and looking at those relative valuations around the globe. I think to your point, it certainly could be considered a little bit risky just to buy kind of the U.S. market in general right now, given the run it's had. But I think the advantage we have with running such a focused portfolio is we can really cherry pick the businesses that we think still offer strong return potential.
Thank you.
Yeah, and I think, John, one of the points that you sort of touched on there, but is a key part of how you guys invest or how we invest, is that the sort of companies that we're investing in are designed to hold up through macro upturns and downturns.
Absolutely, and just to I think this is worth touching on. You mentioned Ferrari, which I think a lot of people hear Ferrari and they think, oh, that must be risky. If the economy turns down, it's probably going to not do very well. It's actually interesting. We've done a lot of work studying the luxury sector, and suffice to say, we view Ferrari as a luxury company, not an auto company. And one of the things we've determined, looking at the winners and losers in the whole luxury category over 30-year period, 50-year period, there are certain common traits that the winners share, and Ferrari really ticks those boxes. Number one being extremely aspirational. At the ultra high end of luxury, those types of brands hold up a lot better, when a 2008 comes along. In fact, Ferrari still had a lengthy waiting list in that time period. And Ferrari, there are some specific things they're doing to really boost their ROICs, and we think they can have a pretty clear path to double their profitability over 5 years. But also having a large shareholder with a really long-term time horizon, so as to not dilute the brand for short-term gain. So in the case of Ferrari, the family still owns a meaningful stake in the business, and other things they're doing with improving the efficiency and commercial aspects of the business. So actually luxury companies, if they're the right ones, can be very defensive in some of those down markets, which is a bit counterintuitive.
Yeah. So Dre, the next question.
We've got another question from Steve Merlichek. Go ahead, sir.
Oh, good. Hi, Steve.
Hello, everybody. Yes, so I'm Steve Merlichek, the Director of Contango Global Growth. John, I had a question on the markets have had a pretty good run, and I suppose the question is, and you might have touched it upon in the last question, valuations. Are you finding it harder to find stocks, or how are you grappling with maybe higher valuations of stocks, and has it changed at all, or is there plenty of opportunities, etc.? I just would like your views on that, if you could.
Yeah, no, it's a great question, and I think naturally when the market has had a move up as it has in recent times here, you get valuations that are higher. And I would say there aren't a ton of, what I would call real fat pitches or real, obvious opportunities where you'd want to, make it a huge weight out of the gate. There are select opportunities, but it's certainly a little bit more challenging, than it was, 18 months ago, say. But I will say, it really varies depending on what part of the market. So one sector that we've actually been reducing our exposure to pretty meaningfully over the last couple of years has been the consumer staples sector. And that's a sector that, at one point was, north of 20% of the portfolio. Today it's about 9 or 10. And that's a part of the market where we've seen really anemic growth from a lot of the really large multinational consumer goods companies. Yet they're trading, oftentimes in, mid-20s PE basis for, a couple percent organic growth. And, some of that may have to do with the yields that they offer and having investors who've been, not getting much returns in bonds and looking for kind of a bond proxy. Something has been propping up those staples. And so that's the part of the market where we're seeing more competitive threats and valuations that don't reflect that. So that's one area we've reduced. And at the same time, we've, I think, found pockets of more attractive valuations in healthcare, which has had some, headline scares, particularly here in the U.S. around reimbursement and pricing. And so that's created some moments of opportunity. And then also in global industrials, there's a few businesses that, for whatever reason, we think are pretty attractively priced. And, Atlas Copco is one we bought a while back that we were able to get on a dip. Anyway, I hope that's helpful.
Yeah, no, thank you. And it sounds like there's still plenty of opportunities out there. Thanks.
Okay, the next question.
From Tom James. Go ahead, sir.
Hi, Tom.
Oh, hi. Thank you for taking my question and for the presentation so far. It's been very good and informative. You mentioned downside capture. How do you actually achieve that? What are you actually looking for in the stocks that you invest in, to achieve that downside capture that you mentioned? And how did you go in the recent correction in February in that regard?
Yeah, great question. So I'll answer the second part first. So the recent correction in February was positive for the portfolio. I think we were, in line to maybe a little bit behind the benchmark for the year. And when the correction came, we picked up a bit of ground, which was encouraging to see. In terms of the broader question, which is the key question, is how have we produced that downside capture? And the key question is why should you have some level of confidence that we can continue to do well on that metric over time? And I could spend the whole day talking about it, but really the key idea, the two key ideas that enable that are, is our focus around competitive advantage and businesses that don't just have a competitive advantage, which I think is the conventional Wall Street thing, because you buy a high quality business with a big competitive advantage or wide economic moat, and you try and buy it at a discount to intrinsic value. We're of the view that there's a lot of smart people around the world trying to do that very thing. And so there probably aren't a lot of inefficiencies to exploit. But worse than that is it can lead you to the value traps where you can really destroy a lot of capital. Companies like Nokia or Tesco out of the UK or Dell Computers here in the US, where they, had this huge competitive advantage, but it stopped getting better and they ended up destroying a lot of capital. So our focus on the research team is looking for companies that don't just have a competitive advantage, but have a competitive advantage that's getting better. And so as we look out 3, 5, 7 years, their economic moat, if you will be wider than it is today. And along that way up, you're going to get a rise in returns on invested capital, and you're going to get stronger durability of revenue growth that's going to buoy those stocks in tough markets. I think also, and this is not as unique, but the bar for these companies in terms of things like their balance sheet strength and their consistency of cash flow and earnings is very high. The capital allocation skills of the management team, I think those are more commonly practiced, but those also help because these businesses tend to be relative safe havens when the markets get spooked, and so they attract a wider audience in those down times. And if we're right about the business being able to invest and go on offense to grow its moat, maybe in a tough time, they're going to come out of that downturn stronger than their competitors. So that's the idea.
Fantastic. Thank you.
Okay, Dre, next question, please.
Next question will come from Noel with Wee Ressingham. Go ahead.
Thanks for taking my question.
Hi, Noel. How are you?
Hi, Marty. How are you?
Good, mate.
Thank you for taking my question.
Thanks, Noel.
Mate, I'm quite pleased with the 10 stocks that you hold in this fund. But I observe this performance of these stocks every day, and they are doing reasonably well. And some days they do. Every single stock in this fund goes up, while CQG price goes down.
Yeah. Okay. Well, I'll answer that question, John.
Holding this.
Yeah. So Noel, look, I think it's an excellent question, and appreciate you asking that. So look, this is one of the challenges that exist with the closed-ended fund structure, and CQG is a listed investment company, and basically it means that the way in which the fund is structured is that it's closed-ended. So unlike an ETF, which is an open-ended fund where new units are created every day, the number of shares in this structure is capped. So basically, the share price goes up with supply and demand and doesn't always follow the actual performance of the underlying portfolio. And basically, the performance of the portfolio is very good. It's sort of made over 10%, but the share price has been lagging that, and a lot of the listed investment companies through periods of time will trade at a discount. And basically, it's trading at a discount at the moment because we at Contango need to do a better job in actually selling this story. And when I say selling this story, we need to get more investors buying this fund. And when we get more investors buying the fund, then that's what will result in the share price going up. And so, we've made some changes at Contango with regards to the management team. Sort of my role is to come in and really help grow the support for a number of our key assets, of which Contango Global Growth is a key asset. And the way in which we're going to do that is by doing the things that we're doing now, doing these quarterly teleconferences and getting more investors engaged with the story of Contango Global Growth. We've enhanced our investor communications with regards to the number of newsletters that we send out and the quality of content that we provide twice per month. We're doing more events and seminars where we're going to be promoting this fund to tell people about this story. And then most importantly, we're spending a lot of time and we're investing in a high quality distribution team. But I personally have been spending a lot of time getting out there and trying to build more relationships with financial advisors who will start to invest and start to buy in to the Contango Global Growth story. So we're doing a lot of foot slogging and we're getting out there and seeing people. And the reality is that we're trading at a discount at the moment. So it's actually the right time for a new investor to buy Contango Global Growth right now, because it is trading at a discount. But on the flip side, some people have invested at $1.10. We as a business are highly incentivized to get this share price trading well above $1.10 because, sort of in the middle of next year, we're going to have an options expiry. And in order for us to grow this closed-ended fund, which is what a listed investment company is, we will need to exercise those options. So, we're going all out and trying to promote this product and to sell this story. And once we start rolling out these strategies, or I should say, as we continue to roll out these strategies, we believe that more people will start buying this investment. And when more people start buying the investment, that's what will get the share price driving up. So some LICs trade at discounts, some trade at premiums, some trade at sort of NTA. At the moment, we're at a discount, but the focus is very much to get it trading at a premium, Noel.
Yeah, mate. The thing is, when you look at the performance of the fund, even I was thinking of buying.
Yeah.
It's very difficult for people to take a risk on this fund when there are so many other funds that are there, I have invested in so many other funds.
Of course, yeah, absolutely. And so, look, I think that's that's the decision the investor has to make. And really, with a listed investment company, there are sort of two things that need to happen there. The performance needs to be good, but the marketing performance of the manager also needs to be just as good in order for the LIC to trade at a premium. So if it was an open-ended fund, like an ETF that is open-ended, then the performance of that portfolio the share price, I should say, of an ETF will track the performance of the portfolio, less the fees. Where with a listed investment company, there can be the correlation is not always there. But Noel, we appreciate those comments, and we're going to be working very hard to get this trading at a healthy premium. So thank you very much. We might go to the next question, Noel. Thank you.
Thank you.
Right, thank you. No more questions as of now, Marty.
Okay. Well, look, sorry. Okay. I've got a question for you, Jon. So we've sort of, the key focus for the portfolio is in that sort of consumer technology and healthcare space. We've touched on healthcare with West Pharmaceuticals. These I'm assuming, is a consumer play?
It is.
Yeah. So we talk about technology at the moment. Are we underweight or overweight technology, and what sort of holdings what's our top holding in that technology play right now?
Yeah, we're overweight technology by about 10%. So, we think more in absolute terms. We're not too concerned about what the benchmark weights are, and we certainly are going to be very different from the benchmark. So more than a quarter of the portfolio is in technology. We're in a pretty unique period in terms of the weights where there will be times where you may see, 5 or maybe even larger percent weight in a single name. But today, we're a little bit more balanced because some of the tech names that had a huge run last year, we've trimmed back, like Amazon, like Tencent. So there's a handful of names that are kind of at that, 3.5%, 3.6% weight. But there isn't, one that really jumps off the page in terms of being particularly large. But certainly, we'd have to talk about Mercado Libre. We have to talk about Tencent as being a couple of meaningful ones there.
Jon, Ferrari was a product that we spoke about before, and the luxury market. You mentioned that it's got a number of defensive qualities. Are there any other well-known luxury brands in the portfolio that the audience would be interested in hearing about?
That's really the primary one that's in the portfolio today. There are a couple other that are on our watch list that are under consideration, and candidly, we're perhaps waiting for a little bit of a break in valuation. But suffice to say, we're going to be targeting just like the ultra high end. So we're not going to be as interested in, say the Gucci's of the world, but more aspirational than that.
Yeah, and we seem to we have some big consumer plays. Our top holding at the moment is Techtronic Industries, I should say, at 3.8% of the portfolio. Not a name that you hear a lot about, but there are some very well-known brands in that portfolio, aren't they? In the portfolio of brands within Techtronic.
Absolutely, yeah. This is a business, like you said, a lot of people aren't real familiar with the Techtronic name, but they're based out of Hong Kong. They're one of the second largest manufacturer of power tools globally, only behind Black & Decker. But some of their more prominent brands would be, Milwaukee, Hoover, Dirt Devil, Orec, AEG. And this is a business that is, just executed supremely well. They've really been the leader in moving to cordless power tools. And they've got an exclusive deal with Home Depot. And if you ever listen to the Home Depot earnings call, they've actually, specifically been calling out Techtronic's Milwaukee line as being a huge, driver of growth. And
Jon, we've got another question, so I might just interrupt you there.
Sure.
Next question, Dre.
Dean Frey, go ahead, sir.
Hi, Dean.
Hi there. How you doing? This is really a question for the Contango side rather than the US fund manager. I participated in the Contango microcap issue, and when that became rocky, Contango divested itself of it and sold it off. So my question really is, given that Contango seems to be having trouble with CQG, how committed are you really to this fund?
Yeah, look, I think that's a good question, Dean, and thank you for asking that. And look, I think basically the sale of CTN to NAOS was basically part of a strategic decision that the business made to really focus on a couple of key core areas. And so we made a call that as a business, we didn't want to be in the institutional investment space. There are a lot of cost requirements, and it was an area where it's highly competitive, and it was an area that we were finding that the business didn't have the opportunity to grow. The areas in which we've decided to focus on now in order to grow our business is in that retail space, and essentially what we're looking at becoming, and which we're focusing our energies on right now, is a marketing and distribution platform that allows high-quality fund managers to access the superannuation market in Australia. WCM is an example of a high-quality fund managers. They're a top quartile global group, and they're a brand that we have an incredible amount of respect for, and a partnership that we are 1,000% invested in. So we are completely committed to Contango Global Growth. The group moving forward is looking at becoming a specialist listed investment group, and we're focusing on our key assets, and our key assets are Contango Income Generator, which is a high-quality income product, Contango Global Growth, which is obviously the fund that we're here talking about today, and our investment in Switzer Asset Management. The micro-cap space was an area that wasn't really a core part of our business, and it's a very expensive mandate to manage, and it's an area where we believe there are others in the market who can do a better job than us. So that's why we decided to exit that. On the flip side, that allowed us to capitalise the business quite extensively. So we're in a position now to roll out this strategy of focusing on the self-managed super industry, the self-directed part of the market, and the independent financial advisory channel. And Contango Global Growth is a key part of that strategy.
Okay. I mean, thanks for your answer. I hope you work to more clearly instrument that strategy to the through shareholder communication, I guess, is my only sort of comment.
No, I think that's very good feedback, and we'll definitely be taking that on board and watch this space, Dean. Thanks for the question.
Thank you.
Get a question from Richard Dalidowich. Go ahead, sir.
Hi, Richard.
Hi there. Thanks very much. I guess the question relates to John, and that is regarding a specific company by the name of Align Technology. I would have thought this is a company that would suit the portfolio in terms of its growing mode and its leadership in designing and manufacturing invisible braces. Have you actually ever looked at this company?
We have, yeah. It's a business that's on our focus list. We met with the management team over the summer, so it's one where we like the business. I think there's some question marks based on some even newer technology than what they have, but I think really valuation has been our biggest hang up. So we would agree that it's a strong business. It's got good growth. It's got some good competitive advantages, but just mainly valuation has kept us out to this point.
Right. Okay. Thanks.
Okay. Well, look, we're close to finishing. I'll just check, Dre. Are there any more questions?
No more questions as of now, Marty.
Okay. Well, look, we'll wrap up today. I just would like to thank all the audience for your participation. We very much appreciate your time and all your support. This is part of an ongoing communication strategy where we're going to be getting out to the investors on a regular basis to answer your questions, to talk to you about what the plan is for the broader business. This webinar, or teleconference, I should say, will also be uploaded to our website at contango.com.au, so you can listen to it or share it with any of your friends. Contango Global Growth is a high quality investment. It is trading at a discount at the moment, so it is a good time to buy it if you believe in the story of the manager being able to market this fund. The investment manager themselves, performance and track record speaks for itself. So if you do want to buy it, the code is CQG. And if you have any more questions for us, please contact us at any time. You can call us, you can email us. I'm always available to talk to any investors. My phone number is 0407 297 702. Feel free to call me at any time, and thank you very much for your time and support. And we'll leave it there. Thank you.